Globally, market conditions are worsening, and this is pretty obvious when you have interest rates at rock bottom and the markets are still volatile. Global policy of 0% interest rates is causing this extreme volatility. You came here for the truth, so let me unveil that for you. This right here is out of the Telegraph. How low can you go? Sweden cuts the interest rates to 0. They're not the only ones that have done this. Of course, many other countries around the world have chosen this same policy, and this is all since the financial crisis of 2008. And they joined Switzerland as another European central bank to slash the benchmark repo rates. And this has become yet another consistent policy that I've been watching over these past few years as countries have to continuously reduce the amount in the interest rates they pay. Now, there's multiple reasons why they do this. The number one reason I will suggest is that this is easy money policies. Now, it's not easy money for the individual because, of course, your credit card rate hasn't declined at all. This is money that the banks get. So this is a way to channel money from the governments and from these central banks which operate outside of the governments and funnel that into the hands of the bankers. It is quite the impressive scheme that they've figured out here. And of course, the mainstream financial analysts don't realize that. Somehow they believe that buying up toxic, what they call assets, debt instruments, are going to then allow them to support the economy. This doesn't make a single ounce of sense, and of course it is going to be doomed. It is meant to be doomed, and that is really what's going to happen when you have trillions upon trillions of garbage sitting there, and they're going to need that to be bailed out. Of course, there isn't enough money to bail it out, and that's when they allow us or try to get us onto this new currency system that they have put in place already. It's problem, reaction, solution, the Hegelian dialectic right at work, and we're watching this happen in advance. It's pretty easy. You don't need a crystal ball to see that. And right at the bottom here, they said the move is designed to increase lending and thus force prices higher amid worries about deflation. That is not going to happen. It's not going to work. It hasn't been working over the past few years. It's not going to work over the next few years. So let's get on to this right here. Out of the Bank of Canada, right here, they said by December 2009, the U.S. federal funds rate sat at 0.12%. England, Switzerland, Japan, they all had 0.4, 0.25, 0.10 respectively. And I'll just stop there for a second and just suggest this is practically 0%. They're playing around with the numbers 0.45 and so on, but that is essentially at 0%. And these are all of the central banks around the world. They need to remain competitive. At the same time, they need to pull off this scheme that I just discussed previously. And then they go on to say, at the same time, a number of central banks engaged in unconventional monetary policy such as credit easing. Now, it's quite funny that this is coming out of the Bank of Canada when some of that quote credit easing was coming from the Federal Reserve in order to bail out the Canadian banks. Quite the scheme that they have developed, giving money to banks all around the world, all done by a single central bank, the Federal Reserve. Quite an interesting story there. This right here information is from CaseShiller, also from Zero Hedge. San Francisco year-over-year price increase per CaseShiller. And what they're saying is that never before has what's happening right now not ended up in a crash of some sort, some degree. They had bigger and smaller crashes, of course, but every single time, 100% of the time, this has been the case. So we are definitely expecting a crash to happen according to this chart. Quite interesting to look at. If I go on here, some more information out of the BLS, median income for the 25 to 34 year olds as a percentage of national median. This is quite interesting how you look at it as it's beginning to decline, and this has been going on for decades. Our real wealth has been declining decade over decade, and they're not doing a single thing about it. In fact, they're making it worse. And this is right at around that 1971 point when all of the monetary system changed forever. We are now hitting a new degree of that as they need to bring us onto a new monetary system that will undoubtedly be worse than where we are at today, if you can even imagine that. So going on, this is basically showing you how more and more individuals are becoming renters. This isn't just in Germany, as the article is talking about, but take a look at this. In Canada, less than 70%, the United States in the same situation, and then you go down to Germany and Switzerland, are hanging around 40% of the people are homeowners. This is a big number when you factor in how many people are not able to afford a home because it's simply just gone overboard based on their income. So these numbers are not matching up. And why? It's because of the policies of these governments, of these central banks, that are making things difficult on the average citizen, on the middle class. And effectively, they will be wiping out the middle class in short order, I assure you. Right from the source itself, this is census.gov. In the third quarter of 2014, the median asking rent for vacant for rent units was $756. What I'm trying to show you for this is that the rental prices are going up, but the income that people are making, in fact, is not really going up at all. And over the past few years, it hasn't gone up at all. It's decreased, in fact, as you look at it in real terms, of course. But look at this, even the rental price, which will never be calculated properly into their real fake CPI ratings, of course, does not show the extreme rate that this has been increasing over these past few years. The chart starts in 1995. It really isn't that long ago for it to be going up at such a high rate. And in my book, I talked about this. The boom was fueled by the continuously lower interest rates and government policies that allowed virtually everyone to own a home, even when they couldn't actually afford the mortgages. If interest rates rise beyond their record lows, even more people are going to be forced to become renters. So imagine these statistics being skewed even more. That is what we are looking for into this near future. It is something that you need to keep your eye on. Interest rates are probably the most important economic indicator for the foreseeable future. If they rise even a little bit, the economy simply can't handle it. And this goes on overseas as well into Europe. Bloomberg states this: euro outflows at record pace as the ECB promotes exodus. This is the ECB President Mario Draghi saying the price of a weaker euro to boost the economy and stave off the deflation is a record exodus from the continent's financial assets. And what they're basically talking about here is that the euro is now weakening because people have lost faith in it. And that is really, all one currency versus another. So right now the dollar might be stronger than the euro over these past few months, but ultimately you're rating currencies, fiat currencies, one against another. What about rating them against real goods like food? And you find that food prices are increasing in whatever currency you measure them in. It doesn't matter how they are looking at these currencies floating in between each other. That isn't the case. You have people really losing faith in those fiat currencies, and they should be, because you should not ever trust these central bankers. That is quite obvious. They've made it public what they want to do in the future. And this is something that the financial analysts will not cover. But of course, at the Money GPS, I will always cover this information direct from the OECD. And I'm talking about fertility rates for these countries. There are many countries being shown here, but you can see that it has been declining for the most part over the past few decades in all of these countries. And you're looking at this being a huge problem over the near future because, just as an example, in Canada, it's less than 2. So So when you have a fertility rate that is very low, in this case 1.61, you cannot sustain a future with that when you have these extremely low levels of fertility. You don't want it to be necessarily too high, but at the same time, you want to be able to have a future for some taxpayers to pay their taxes, which then go to be squandered, of course. You need to have a higher level of fertility or your economy will be doomed in the future. If you found this video informative, please give me a thumbs up and don't forget to become an insider. The Insiders is where I give out all my best intel for free, and that is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.